First, welcome to our deep dive on whether you should fund a car using home equity. We will explore rate comparisons, collateral risks, practical steps, and common mistakes to help you make a prudent decision. We will also include quizzes and visuals to reinforce your understanding. Next, here is our roadmap. We will begin with why this decision matters, then examine the math and rate arbitrage, followed by the collateral risk discussion. After that, we will walk through a decision framework, a practical case study with scenarios, and 2 quick quizzes. Finally, we will wrap up with key takeaways and next steps. Before we go further, a quick disclaimer. This content is for educational purposes only and is not financial, legal, or tax advice. Individual situations vary significantly. Please consult a licensed professional who understands your specific circumstances. Now let us establish the context. Many families face the need for a larger or more reliable vehicle during major life changes. At that moment, a key question arises. Should you take a new auto loan at a higher rate or tap existing home equity at a lower rate? We will balance the appeal of rate optimization with the realities of collateral risk. Moving on, let us look at the math behind rate arbitrage. If your home equity funds cost 6% and a comparable auto loan costs 7.5%, the lower rate will reduce your interest cost. Using equity may also help you avoid a new, separate auto loan payment, thereby improving cash flow flexibility and enabling accelerated repayment. However, it is crucial to remember that debt remains debt. Not having a separate car payment does not eliminate the obligation. The principal still must be repaid. The mathematical lens is straightforward. Minimize interest rate, and then aggressively pay down the balance. Furthermore, consider a $15,000 vehicle. If an auto loan at 7.5% is amortized over 60 months, the payment is roughly $300 per month. If financed through home equity at 6% on a 60-month schedule, the payment is roughly $290 per month. The interest-only payment on the equity balance would be about $75 per month, but that is not a payoff plan and should not be treated as such. Over 5 years, the overall interest savings may be a few $100s, depending on amortization and exact terms. The more meaningful advantage can be the improved cash flow flexibility that allows faster repayment when managed intentionally. Next, let us compare the 2 approaches. Home equity often provides a lower rate, consolidates payments, offers flexible cash flow for acceleration, and may allow longer draw or repayment options. However, it also secures consumer debt with your home, which raises the stakes significantly. There may be variable rate risk if you use a line of credit, and there is the behavioral temptation to pay more slowly due to lower required payments. Fees or closing costs can also reduce the benefit. Now let us focus on collateral risk. A vehicle depreciates quickly, while home equity borrowing is secured by your house. If you default, your primary residence may be at risk. In addition, interest on home equity used for personal expenses like a car is typically not tax-deductible in many jurisdictions. You should verify with a qualified tax professional. If you use equity, commit to a disciplined payoff schedule that mirrors or improves upon a standard car loan payoff. After that, follow a prudent decision framework. First, confirm the vehicle is a necessity. Second, compare rates across auto loans and home equity options, noting whether terms are fixed or variable. Third, factor in fees, closing costs, and any prepayment penalties. Fourth, stress test your budget to ensure you can handle potential rate increases if using a line of credit. Fifth, isolate the portion of home equity used for the car so it remains trackable. Sixth, establish a payoff plan with automatic transfers equal to or higher than the car payment you avoided. Seventh, monitor your progress monthly and continue to make additional principal payments while targeting a specific payoff date. Consequently, here are approximate side-by-side scenarios. For an auto loan of $15,000 at 7.5% over 60 months, the payment is approximately $300. For home equity amortized at 6% over the same period, the payment is approximately $290. For an interest-only home equity approach at 6%, the monthly interest would be about $75. But this does not eliminate principal and is not a payoff strategy. In this mind map, the central question is whether to fund a car with home equity. The branches include necessity, rate comparison, collateral risk, cash flow management, term and structure, tax considerations, and the exit plan. Each branch reminds you to verify whether the vehicle is essential now, to compare auto and equity rates including fees and whether the rates are fixed or variable, To recognize that using your home as collateral raises the stakes, especially given vehicle depreciation. To manage cash flow via autopay and extra principal payments. To consider amortized versus interest-only structures and any draw period nuances. To check tax treatment. And finally, to choose a clear exit plan with aggressive payoff or potential refinancing if appropriate. Meanwhile, here is a mini playbook in Markdown. The rule of thumb is to choose the lowest available annual percentage rate and then pay it down quickly. The payment strategy is to set automatic payments equivalent to the car payment you avoided, add extra principal when possible, and track the remaining balance separately to keep it visible. A quick formula to estimate monthly interest is principal times rate divided by 12 years. Red flags include relying on a variable line of credit without a repayment plan, assuming interest is deductible when it likely is not for personal car use, and confusing the absence of a separate car payment with the elimination of debt. Next, here is a quick quiz. If your home equity annual percentage rate is 6% and a new auto loan annual percentage rate is 7.5%, which option generally minimizes interest cost, assuming equal payoff schedules? Option A, the auto loan at 7.5%. Option B, the home equity at 6%. Option C, both cost the same. Option D, it is impossible to know. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. Now the correct answer is option B, the home equity at 6%. A lower annual percentage rate generally results in lower interest paid, assuming you follow a similar or faster repayment schedule. Next, a second quiz. What is the biggest unique risk when using home equity to buy a car? Option A, the car might depreciate. Option B, you could risk your home as collateral. Option C, the paperwork takes longer. Option D, you cannot make extra payments. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. Now the correct answer is option B. When you use home equity, the debt is secured by your house. This raises the stakes considerably if your cash flow declines or an emergency occurs. Additionally, avoid these common mistakes. Do not treat interest-only payments as a long-term strategy. Always isolate and track the car portion of your equity balance. Be mindful of variable rate risk on lines of credit. Do not stretch repayment beyond the vehicle's useful life. Finally, do not assume tax deductibility without verification. In summary, prioritize prudence and confirm the vehicle is necessary. Optimize for the lower rate while acknowledging the elevated collateral risk to your home. Mimic a car payment through automatic transfers and add extra principal when possible. Track the equity portion used and target a rapid payoff. Revisit your plan monthly and adjust if rates change. Finally, should you use home equity for a car? It can be a fit if it truly lowers your cost and you commit to an accelerated payoff. It is not ideal if you cannot accept the collateral risk or are likely to pay slowly. Always stress test your finances and consult a professional. If this video helped, please like, share, and subscribe, and tell us your strategy or questions in the comments. As a final note, thank you for watching. Please like, share, and subscribe, and let us know your plan or questions in the comments.